Well, a very good evening for those listening in to what has been a bit of a momentous day. I'm not sure if many of you out there actually watched what unfolded overnight in the Rose Garden, where President Trump pulled out his little handmade Koki board and went through the varying tariffs applied to the global economy. Anyone who did not believe there'd be significant repercussions and volatility the next day clearly is not living in reality. Because as we've seen in the course of the trading today, there's been significant blowback, not just in the US economy, with the Nasdaq and the Dow falling quite sharply, but across the European markets and, of course, domestically here in South Africa. From my perspective, if you see me reaching for my soft drink, it's because I've got this perpetual little niggly cough, which I can't get rid of. So if I take a break every now and again to have a sip of water, it's not fatigue, it's just this perpetual cough. So moving back to the domestic marketplace, I think we all saw what happened today. It was a day of whiplash and roller coaster movements. The Aussie end of the day down 3.4%. It was substantially lower. The small cap index was down 3.68%. It was again materially lower earlier on in the day. And the mid-cap index was the hardest hit, down 4.61%. Again, it was significantly lower. The Rand blew out against the dollar to 1877. And the only place to be during the course of the day has been in gold, which continues its upward trajectory. Year to date, the yellow metal is up 19.26%. And there was a flight to safety. On the JSE, counters like British American Tobacco, AB InBev, the brewing company, Hammerson and Shaftesbury, the UK listed property company, and Sirius, the German property company, were all in the green, as any portfolio manager brave enough to trade in today's market looking for interesting stocks looked for defensive, fairly reliable counters, and it was those five that were the main players. Alongside, of course, the gold stocks, which year to date have been the substantive performers on the JSE. I gave a presentation to a material institutional investor on Tuesday morning to their nationwide network. And as of Tuesday, which was the end of quarter one, if you were not in the likes of Harmony Gold, DRD Gold, Anglo Gold, etc., you would not have made any material returns. I think those gold stocks are up between 40 and 70% year to date. And the laggards in the market are some of the retailers like Mr. Price and Pepco and some of the other financial counters. So it's been a very interesting month, yet alone an interesting year. As I said to Pascal before I came on this call, I'm going to do this webinar today a little bit differently. Nobody has a crystal ball regarding what is going to be happening in the next few days or the next few weeks, regarding the global fallout to what President Trump, or as I nicknamed him earlier to Pascal, Orange Jesus, will actually have to the global order of the economy. Mr. Trump seems to think it'll be a reset, but the reset is causing significant turmoil and panic. Domestically, South Africa has been in the crosshairs of Trump and the US government, with significant levels of animosity and angst, not just from our ambassador being kicked out, but threats of targeted sanctions and perhaps even repercussions against members of the government for what Trump believes is some terrible things going on in this country. Anyone that listened to the live Rose Garden call yesterday, when he mentioned South Africa, he actually stopped for a second, and before he pointed to the tariff, he said there are some terrible things happening there in South Africa, which the fake news media will not investigate, and perhaps they should. And then he moved on to say we're having 30% tariffs. So even in the height of his prognostications regarding the reordering of a global economic empire, he took time out to take a swipe at this little country at the tail end of Africa. So I'm sure with the AGOA free trade agreement, the next to be ultimately discussed in the coming weeks and months, if we lose that, that'll be a significant blow to certain elements of the economy. I saw a social media post earlier, which was, which was completely correct. But given the tariffs on imported vehicles that the auto manufacturers in this country will be significantly hit. And any of those large automotive companies out down in Uitenhage, like Volkswagen, Mercedes, etc., must be quaking in their boots as to the potential repercussions going forward. And then if we lose our free trade agreement with AGOA, that'll make the pain even worse. Even on the agricultural side, I spoke to some of the agricultural counters this morning, and there's considerable concern that the tariffs on this country could have an impact on the substantial amount of agricultural goods that are exported from this country on a yearly basis. South Africa, for example, exports around 72 million cartons of table grapes. We're the world's second largest producer of citrus, and we produce significant quantities of apples and pears and stone fruit for the global market. And much of that goes into the Western economies. And it will be fairly difficult at a short-term basis to try and reorientate that back towards other markets to get away from a tariff situation. But the initial feedback that I had from the agricultural companies is, in many cases, certain products will not be that unduly hit because it's counter-seasonal. So when Western markets in the Northern Hemisphere want table grapes at Christmas, they have to buy from certain markets if they want them. And in America's case, given the disease and the problems in the vast Florida orange fields, we've just seen the price of frozen concentrated orange juice soar in the last 12 months. Disease is not eradicated overnight. So there will always be a demand for citrus for the orange juice that graces the table of American breakfasts every morning. So, but at this stage, I'm certainly not an economist, and I'm certainly not a strategist. We just try and decipher what we can. But as I said to Pascal before I came online, it's going to be a difficult few days and a few months until all of this settles down, with all directionality being driven by the United States. And as we've seen today, the Dow and the Nasdaq have fallen extremely sharply. Firstly, a very great thank you to Rand Swiss to once again allowing me to participate in their webinar. The chat box is open. I'm going to run through very quickly a few of the stocks that I cover, and then I'm probably going to take questions and answers towards the end, probably far more than I've done in the past, because quite frankly, in a fast-moving environment, whatever I may tell you regarding individual stocks today may be completely different tomorrow, given market volatility and whatever that gentleman in the White House suddenly says when he opens his mouth sipping a Diet Coke. As many of you may see on my social media page, Small Talk Daily, excuse me, my top 10 stocks continues to run regardless of the market's volatility. When I choose these stocks in early January and publish them to my institutional clients, they are cast in stone for 12 months and cannot be changed. So even though my underlying recommendations on a day-to-day basis may change for obvious reasons, given the state of play of companies and markets, in my top 10 portfolio, they're cast in stone. So year to date, up to quarter three, the end of March, the portfolio is down 8.85%. That compares to the small cap index at point of selection to the end of March, down 5.57%. The mid cap down 1.09%, and the Aussie being up 6.6% as of the 31st of March. The month of March was extremely brutal. It was reporting season, and I've probably seen north of 30 companies in the course of the last 12 months, course of the last month or so. Just this week alone, I've had lunch with CA Sales, which has been one of my favorites since October 2022 at £5.45. It was £17.50 yesterday. I haven't checked the price today. I had lunch with Stadio today, which again has been my top pick in the educational sector, chosen in June 2024. And is now trading at around £7. It's up 51% in the last 12 months. And then tomorrow, I'm catching up with some other companies in the general infrastructure and DIY and aggregate space to see what is going on in the wider field. I spent 2 days last week with PPC on Capital Markets Day and a site visit to their intended RK3 plant here in Riebeck, where they intend to build the lowest cost cement factory in the country, which should be open in the next couple of years. So just as a reminder, what's in my top 10? It's Advotech, Cashbuilt, Combined Motor Holdings, Grindrod, HCI, KAL Group, Nampak, PPC, Rainbow Chickens, and RFG. In looking at those stocks and having probably met most of them in the last month or so, aside from the ones which have March reporting periods like HCI and Nampak, all the companies that I've spoken to have reasonable prospects. There was nothing in the line of sight which have led me to change my underlying view of the companies. But of course, a market is a market is a market. Good stocks get hammered alongside bad stocks in a falling market, particularly one where there is extreme volatility driven by geopolitics and, of course, what is going on the economic front by a reorganizing of the global trade policy by President Trump. But interestingly, looking back on the month of March on my top selection, the best performer in the month of March, interestingly, was PPC. That was up 18% during the course of a month. It was substantially higher, but gave some gains back towards the end of March. That was all purely driven by the Capital Markets Investor Day and the site visit, where institutional investors were unpacked the current trajectory and scenario inside PPC by the CEO, Matthias Caldarelli, who is doing wonderful things inside PPC, as he calls it, to awaken the giant. So the new plant that he's building here in the Western Cape in Riebeck will see two older plants, which are 40 and 60 years closed, and this new low-cost plant built at a cost of 3 billion rand. And once that's sunk into the eyes of the market, and the rationale behind the capital expenditure, which initially caused the share price to slump when it was announced on the 21st of January, caused the stock to sharply rally in the last few days as the market understood succinctly why that investment actually has to happen for the good of PPC. The other best performing stock, if you can call it that, during the course of March was Advotech, which was up 3.7%, and Combined Motor Holdings, which is up 1.5%. Now, all of these percentage numbers are all as of the end of quarter one on the 31st of March. You know, the world's gone to hell in a handbasket in the preceding days, but I'm just using this as a benchmark. Advotech had extremely good results out in the last couple of weeks. I actually met with the company last Wednesday in Cape Town. I had the first one-on-one and engaged for about an hour and 20 minutes with the company. And as I regaled to clients on Tuesday, in terms of my ranking schedule for schooling stocks, my number one stock as of June of last year was Stadio. My number two was Advotech, and my number three was Curro. And exactly a year later, Advotech is up about 11%, Stadio is up 51%, and Curro is down about 30%. So my report card as of June last year has played out quite nicely, and I have no reason to change that ranking. Curro has been completely smashed since its year-end results, which came out a few weeks ago. The market once again took fright at the ongoing impairments of underperforming schools, which have now seen 750 million rand impaired against underperforming schools. And the fact that unlike the other schooling stocks, which have seen net growth in underlying learners, Curro seems to be going backwards. So there's a dichotomy going on in the private schooling space, where the likes of an Advotech in its schooling side is growing at between 4 and 6% per annum, and Curro, quite frankly, is going backwards. It makes one wonder what is currently going on inside the company, and I'm sure the investing community will have some very hard questions for the company in the coming weeks and months if reporting for the June interims show consistent or continual fall in the underlying number of learners and the scope of the business. So as it stands right now, my number one pick in the education sector remains Stadio. Combined Motor Holdings has held fairly steady, although it has taken a dip today with the overall market. I was trading at about 31 Rand 45 at the end of March. It's a February year end. They had a fairly sort of okay Christmas season regarding their car rental business. They own the first car rental company in this country, which benefits significantly from the inbound tourism. But there was a price war once again from one of the smaller players, which caused average vehicle daily rental rates to actually dip. So even though utilization was quite well attuned to the marketplace, a price war led to an underlying crop in margins. We've all seen from the NAMSA stats that new car vehicle sales in this country have been increasing for the last few months as interest rates start to come down, although not as fast as many would assume. And affordability of new cars continues to be the order of the day. Where, for example, the Suzuki brand, which is the key master brand of Combined Motor Holdings, actually outsold Volkswagen in the last month, showing that consumers, if they want to buy a new car, looking for value, and they want as many bells as whistles as possible at the lowest possible price. So those with affordable brands seem to be doing quite well at the expense of perhaps brands that have been living on their reputation for quality and blue chipness. At the end of the day, the consumer has only so much money to spend. And as it seems globally and locally, they want value. So CMH has done rather well, I believe, in the new car vehicle sales and the used vehicle sales. So given the company has a net cash balance of around 700 million rand and is a small cap, I've had a straddle, which basically means you go long of one stock and short of another. And my long has been CMH, my short has been Lotus. And year to date, that has been, again, the place to be, where CMH has been up quite nicely. And the last time I checked, Motors was down about 22, 23%. So a perfect straddle. The other counters running through quickly. Cash built had a horrendous March. They were down 16.1%. Even though the results that came out were, fairly adequate. I think the pace, or should I say the lack of pace in the economy, and the fact that consumers are really under the whip. I've gone through reporting season and I ask CEOs the standard question, how is the consumer currently in your underlying business? And I get the answers, the consumer is flatlining, the consumer is tight, the economy is not growing, there is no money in the system, there's inability to push up prices, margins are being constrained. And that tells you that the underlying government of the GNU, still dominated by the ANC, who clearly think they run the show, has not really pushed the growth agenda. It's all about trying to prop up their patronage network and to keep the grant system flowing ahead. Growth, quite frankly, can be damned in the eyes of the GNU, and that has to substantially change. Otherwise, the likes of a Cash Built and an Italtile and other companies operating in the infrastructure and construction space will not see any material growth. So I remain ever hopeful that at some point, the powers that be sitting on their fat, comfortable chairs in Parliament, bilking us for our tax money, will realise that the wider economy needs a shot of vitamin B in its economic backside to kickstart the economy. Again, on the month, Grindrod was down 7.7%. Again, they had a fairly good set of results, but what upset the market was that they went out with a very aggressive growth tack, saying that we were going to spend 8 billion rand over the course of the next few years on a combination of organic expansion and or acquisitions. Now, some of the underlying expansion, particularly in Mozambique with the Matolo and Port of Maputo infrastructure, is needed. The underlying volume of tonnage going through those ports is continuing to grow, and Grindrod is very well placed. Similarly, the passing on the 20th of December by Minister Creasy, the Minister of Transport, of the rail public-private partnership will again be a boon for those companies involved in rail, like Grindrod, alongside the ports. But all of this takes money. And even though Grindrod has a very strong balance sheet and an ability to gear up to probably borrow 2.5 to 3 billion rand, there was an initial concern that have to have a capital raise at some point to fund their ambitions. Luckily, they came out just after the results saying there is no need for a capital raise, and any expansion that they do can be funded from internal resources. And if they do undertake any transactions, they will be self-funding from the profits generated from the companies that they should be buying. So there's no capital raise coming. But I think, given again the possibility of a trade impact and the tariff impact on supply chain and logistics companies, we've seen those fall off quite sharply in the last couple of days on concerns that perhaps trade out of this country and the neighbouring region will be hampered because less goods will be going into the US because of the tariffs. That is a natural concern, but again, it is one that will have to be evolved in the coming weeks and months if the varying countries go cap in hand to President Trump with concessions to try and bring those tariff rates down. Other notable features of the month, KAL Group, formerly Carp Agri, was down 9%. The stock started the year extremely well, trading at around 50 Rand. But as the annual general meeting occurred on the 6th of February, again, they came up with a very, very aggressive growth tack, necessitating substantial capex, potentially as much as 3 billion Rand, which is equivalent to their market cap. And again, in areas of the economy which currently are not performing that well, convenience stores, fuel, and other areas. And I think whilst the strategy in the longer term to continue growing the convenience stores and the fuel network inside Capri will pay long-term dividends. The market just saw again a lack of underlying litres sold, excuse me, and tightness in the market, saying, well, should he really be spending that money? And they came out with a big, hairy, audacious goal, a BHAG. They want to do 1.5 billion Rand of profit by 2030, which is a substantial leap from their current level of profits. And the last target they gave of a billion Rand by the end of this year has already been missed. So I think the market is a bit jaundiced that KAL Group needs to recover its poise. But I'm not expecting any great shakes in the interim period to March. I'm expecting earnings to be fairly lackluster with very modest growth, because whilst there's been an uplift in the agricultural sector, the general retail and the fuel side remains fairly lackluster and is flatlining. Another stock in the news has been Nampak. When they did the Nigeria sale of their beverage of Bevcon, the share price ran from about 405 Rand to about 460. It's come all the way back now to around 411. I'm not too perturbed. I chose the stock again this year as my wild card. It's still up modestly year to date. It's up excuse me, I can't see. It's up 1.1%. But I believe that the underlying business is performing well. So even though Phil Roux, the CEO, stepped down yesterday, and that caused a bit of disquiet amongst the teenage scribblers who spend their life analysing company reports, but certainly don't kick the tires and visit management and actually engage with them. I do engage with companies and I do engage with management. And as I said to a journalist on a call earlier on, if anyone had followed Nampak for as long as I have and attended the results presentations and the annual general meetings, which happened a couple of weeks, oh, sorry, let's say a month ago, you'd have been well aware that Phil Roux's tenure was never going to be until retirement. I was only there for a fixed period to restructure and revitalise the company, which he has clearly done. And even though he's leaving slightly earlier than anticipated, 95% of the heavy lifting inside Nampak has been done. And the transition of handing over the reins to Andrew Hood, who becomes the Chief Operating Officer under Phil Roux, and as Phil transitions his role to him over the next 6 months, Andrew will take over the reins of running the more efficient and more streamlined operating entity, because most of the restructuring, as I said, has been done. Phil is certainly not leaving. He remains on a number of committees, particularly one involved with the strategic planning and the intent of the company going forward, and he remains a non-executive director. So the gentleman has worked 24/7, 365 for at least 2.5 years, and for him to take a break from the job he was brought in to do, I think is a natural thing to do. And as I said, the very fact that the share price ended the day up about 1.2% is clearly indication to me that the institutions that hold the bulk of the shares and who know the story far more closely than the bloggers and the teenage scribblers were fairly comfortable that his departure was, quite frankly, as I said in my blog, no biggie. So Nampak to me remains a very interesting play, and they have the March results coming up, and let's wait and see what Phil and Andrew Hood come out with. Also on the month, having had a very good start to the year, Rainbow Chickens fell 10.4%. I have a preponderance to like chicken companies if you can catch the cycle correctly. I chose Astral Foods last year, my top stocks, and it was up over 30%. I chose rainbow chickens this year at about 3 rand 54 from memory. It got to about 4 rand and it came all the way back to about 305 and is now back to about 344. The market seems to have a bit of a lack of knowledge regarding the chicken sector. I'm not saying that I'm an expert, but I track chicken companies far closer than most. And I get data points from many underlying businesses involved in the poultry network, from feed companies to the pricing of chicken in the varying categories, the retailer numbers, etc., etc. So I have a much more holistic view than just saying that the chicken stocks, quite frankly, are cyclical. Well, they are, but you have to factor in a number of issues. The underlying, excuse me, the underlying price of chicken in the last 12 months. The IQF price is now up 14.4%. The underlying maize price from its recent high is down about 22%. And more importantly, if you look forward to the July price of maize, which is the single largest cost input into chicken production, generally about 60 to 65% of rearing a chicken is from input costs like maize and soya. The maize price looking into July is trading at about 4,000 rand a ton, which is a 30% decline from its high. Soya is also down and pricing is up. Load shedding has mostly been ended, so that cost impediment has also gone from the system. And the chicken companies, quite frankly, will have a fairly indifferent half one, but a materially better half two, as the benefits of lower input costs start playing out in their margins. So I'm of the view that the chicken companies who have been sold down heavily in quarter one for varying reasons should be accumulated at these levels, because the second half of the year should be materially better if the predictions for a much larger commercial maize crop and lower pricing becomes the norm, which I think it is. The futures market is telling you that the maize price is falling, and falling prices are good for chicken margins. So I would be keeping a very watchful eye on Astral Foods and Rainbow going forward, because when chicken companies turn, they turn very quickly, and their profits and margins turn on a dime, to excuse the American parlance. And then lastly, in my top stocks list, we've got Rhodes Foods, which on the month was down 7%. They had a pre-closed update again a few weeks ago, and Peter Hannicom, the CEO, detailed that parts of the company are performing reasonably well, but other parts are not doing that well. There's been a drought in Eswatini, or Swaziland, and as such, the pineapple crop, which is very important to Rhodes Foods Group, RFG, was substantially hit, and that has significantly dented profits in the pineapple segment. And then secondly, some fruit exports, or canned fruit exports, which went into the Far East, were suddenly cancelled by the principal, and those canned products had to be reshifted to other markets and sold at a loss just to get the product off the shelves. And that's had an impact on the first half results of Rhodes Foods. But the underlying business continues to perform adequately, and I have no contention that Rhodes is not a good mid-cap food company. It is significantly better currently in the market than Libstar. So that's the run through of my top 10. Again, just as a refresher, it's Avatec, Cashbuild, CMH, Grindrod, HCI, KAL Group, Nampak, PPC, Rainbow Chickens, and RFG Group. And for the year to date, they are down 8.85%, which is doing worse than my benchmark indices. And not that I'm making excuses, because I publish this come rain or shine. I'm certainly not like other analysts out there that hides their performance when things aren't looking great. And it's a 12-month cast in stone scenario. So let's wait and see what happens in quarter 2, 3, and 4. But when I published my notes in early January, I did say in the opening preamble that given I was writing this with Donald Trump coming into office literally a fortnight after the note was published, and with no indication what his geopolitics and economic scenario and stratagem was going to be, which we now know is basically chaos. We had no idea what the market would do. And I stated that it would be much more difficult in 2025 to make money from a small to mid-cap sector, given the great unknowns and the impact on the domestic economy. And that has exactly happened. Last year, we saw the small cap market up over 30% and the mid cap market up about 15. This year's completely reversed, and all the action has been in the gold stocks and the big rand hedge stocks for obvious reasons as the market looks for safety. I then said to Pascal I would run through some stocks. Excuse me again. I've been working on and visiting in the last few weeks to give you some color about the day-to-day life of a small to mid-cap analyst. I will also remind you on the Q&A. The Q&A is open. My preamble is probably going to end in the next 10 to 15 minutes, and I'll then go to Q&A. And if there aren't many Q&A, this webinar will end early. So I'm urging all of those listening to this webinar, if you have a burning question that you want to ask, pop it in the Q&A chat, and I will get to it if there's time. So I mentioned at the start of this webinar that I've just gone through reporting season, and the list of companies was endless, from Cashbuilt to Spur Corporation, Starjo, Kuro, the likes of PPC. I mean, the list is as long as my arm. CA Sales, Oceana, Sea Harvest. I could go on and on and on and on. And as such, the information flow that comes across this desk is quite substantial. Any of you that follow me on my social media page, Twitter or X or whatever the hell Elon Musk wants to call it these days, will see pictures of my office, which is knee deep in manila files and information, and all the files on the floor are current. They're all the things I'm working on. So my favorite question that is asked by my institutional clients, and I have a very, very large institutional client base, which has thankfully supported my works for over 26 to 27 years now. I've never lost a client, and I keep picking up new ones. So I must be doing something right in the independent world. And those that know me extremely well always ask me, Anthony, what are you working on? Because if I'm working on something, given I'm self-employed and my time basically equals my own cost base, I must be doing it for a reason. And I often look at stocks which are perhaps outside of the market fold. And what we've seen in the last few years with the dearth of brokers covering the small to mid-cap sector, there is very little coverage of many, many stocks in the marketplace. And I often get criticized on social media by those that simply do not understand what is going on in the broking field. And they say, but Anthony, you clearly get privileged or insider information because you get access to all of these companies. To which my standard answer is, if you're the only person covering a stock and you have a wherewithal to get off your fat ass and actually go and kick the tires and engage with management, how can that be privileged? If you're a broker wanting to cover many of the stocks that I cover, then get off your own fat ass and actually go and see the companies. In my case, I've been covering companies now since 1991. So I have a history and a legacy of being quite proactive in my coverage. And as such, if I cover companies that other brokers or other people don't, then tough luck. I'm certainly not going to change my raison d'etre because I'm the only guy that has the wherewithal to cover companies. And one company that I cover very closely is CA Sales, and the second one is SabCap or Sabvest Capital. I've engaged with both of those companies recently. They've both had results. They've both been perennial favorites of recommendations I've given for many, many years. I own the stocks myself personally. I usually disclose that on many of the reports I write for the likes of a Financial Mail and when I make a comment on my social media page. And I've been in SabCap since 28 Rand and CA Sales since 5 Rand 45. SabCap, the last time I checked, was 102 Rand and CA Sales was 17.50. So this analyst often puts his money where his mouth is. And if people don't like that, again, tough. My clients know that I often back my own recommendations. I will either make or lose money alongside my own recommendations. I don't often get it right, but I burn alongside my clients, such as life. But in the case of CA Sales, and SabCap, I want to run through some very interesting dynamics as to why I continue to favor those companies, despite the fact that both of those stocks have recently traded at new 52-week highs, if not all-time highs. Why should you chase these companies in a fairly dynamic market if the underlying stock market is not exactly conducive? Well, it goes down to quality and the nature of the businesses that the likes of a Duncan Lewis runs at CA Sales and Christopher Seabrook runs at SabCap. I'll start with CA Sales because that's more fresh in my mind because I had lunch with them Tuesday. CA Sales was an unbundling from PSG Group back in September 2022. It had a dual listing in Botswana and it then listed on the JSE. And the share price tanked because institutions, when they get a new unbundling, which they don't know what's going on, they generally sell it because the legwork to do the analysis of a company often isn't worth it. So you could have bought CA Sales back in the day for between £5 and £5.50. I had my first buy of stock in October 2022 at £5.45. And the elegance of a company is quite simple. What they do is they take fast-moving consumer goods, FMCG products, which are produced by either local or international companies, into parts of Africa which would be difficult for the large principals like Nestle, Mondelez, Cadbury, Diageo, Heineken, Colgate-Palmolive, Unilever, or the large pharmaceutical companies to do by themselves. So as we've seen Africa urbanize and become wealthier as the population starts demanding, or let's just say as their incomes improve, to want consumer goods, there's a natural pull through for a greater spend in discretionary consumerism. And CA Sales takes the products that those consumers want in the likes of Eswatini, Lesotho, South Africa, Namibia, Botswana, Zambia, Zimbabwe, and latterly Kenya, Uganda, Tanzania, etc., and takes them and puts them on the shelves in the formal and informal space. Now, we as consumers in this country are quite lucky. We can just walk into ShopRite or Pick n Pay or Checkers or Woolworths or Discam or Nuclix and generally buy what we want. But in many African countries, the largest part of retail sales is done in the informal market through street vendors or spaza shops or independents. And as such, you have to have a network of relationships and the delivery trucks and the knowledge to actually get those products to tens of thousands of small drop-off points across Africa. Now that takes skill and expertise, and CA Sales have done that for the best part of 40 or 50 years. Interestingly, for those that know the story, CA Sales is the second incarnation of a company called CIC Holdings, which again was funded and expanded by PSG Group, which was sold to Imperial Group back in 2010 for a fat premium. And some of the existing management, once their restraints had finished at CIC, went on to start CA Sales, and they've now built a 12 billion rand business, which is immensely profitable and is currently trading on a P of 13 times based on the recent earnings of R1.22. They've had a consistent growth in earnings of between, let's call it high teens to early 20s. And I see no belief that that growth scenario is not going to continue for the foreseeable future. Excuse me. The very fact that they recently bought a stake in a Kenyan company to enter the fast-moving East African consumer market again shows you that the ability for CA Sales to take its expertise into other parts of Africa and potentially further afield in the years to come is quite prevalent. And as such, as they say, if they're delivering, a basket of products to an existing retailer, to put a few extra products in that basket costs them nothing, but it gains them significant margin. And that's what they do. They pick up more accounts with more customers, with more goods, taking the products to more places. And they do it swiftly and elegantly. It may not sound glamorous, but I urge you to look at the CA Sales website and look at the company. As I said, you could have bought this stock literally 2.5 years ago at £5.45, and today it's at £17.50. Every single target price that I have set for CA Sales, £8.50, £11.50, £14 have all been met and exceeded. and my current target remains 20 Rand. As I said, the last time I checked, it was 17 Rand 50, so there isn't much more to go at 20 Rand. If it gets to 20 Rand, which I believe it will during the course of this year, I shall reassess my target price, but it certainly will not be a downward revision. If my belief in the growth scenario emanating from parts of Africa, and particularly East Africa, are met, I will be moving that target up quite sharply. So CA sales is certainly one that I have recommended consistently to my institutional clients and in my written works, and it has been a winner from day one. Secondly, it's SabCap or SabVest Capital. It's a private equity vehicle run by serial entrepreneur Christopher Seabrook, who is very well known in business circles for being adept at spotting good companies, assisting in their strategic growth, and then funding them. SabCap has a portfolio worth around 5.4, 5.5 billion Rand in many companies which underlying investors would be unable to invest in the likes of cell phone airtime providing companies, which is DNI 4PL, international labels, trimmings, and garment businesses like ITL, pet food companies like Velmont, liquor companies like Halewood, and industrial companies which own the likes of a Gabriel shock absorbers, elephant lifting, amongst others, inside Apex, and then a very large international export business involved in labels, trimmings, buttons, and braids. It might not sound very glamorous, but every T-shirt that you buy has labels. They all need to be printed and sewn in as a matter of legislative requirements globally. Every shirt that you have has a zip or a button. Someone has to manufacture those. Lots of products has trimmings and fringes and tassels and sequins and bits and bobs. Somebody has to make those. And inside SabCap, I have a company called SA Bias, which has been doing that very successfully for years. And that is one of their largest investments. So in the course of the last 12 months, the net asset value of SabCap rose by 20.8% to roughly 132 Rand. And the discounted net asset value at one point was trading at around 35%. On results that came out, I think a week last Monday, the share price moved from 90 Rand to about 104, narrowing that discount to about 22, 23%. But what has changed inside SabCap is they've exited some of their smaller assets and reinvested the money in repaying the 600 million Rand debt that they have. So they're now mostly debt-free, giving them firepower to invest money back into existing businesses or brand new businesses which are adjacent in areas of the economy and portfolio that they know extremely well. So it is my personal view, having engaged with the company for the best part of the now probably 10, 15 years, that we are now in a golden phase of net asset value growth, where in previous incarnations, SabCap used to provide net asset value uplifts of between 9, 10, 11, 12, 13% per annum, which is respectable. They have a consistent long-term track record of producing above average growth. It is my belief going forward for the next few years, if the scenario that Christopher Seabrook is currently implementing pans out, we could see growth rates of the SabCap net asset value in the 19s, 20s, 21, 22%, which is a material step change in the underlying value, which means when I put my last recommendation out on SabCap at 87 Rand, and I said it's now about 102, 104, the underlying growth in net asset value could see the share price move quite rapidly. So I'm currently formulating my view on SabCap. My last net asset value target, was exceeded, as has every price target I have set. So I'm currently formulating a new price target on SabCap. My gut feel tells me it'll be probably about 120 to 130 Rand, which means there's still reasonable upside in the share price. And I would certainly use market volatility in the coming days, weeks, and months to accumulate or buy that stock if we saw the price back to, in the 90s. It is a seriously good quality business, run by a very accomplished entrepreneur with skin in the game. Christopher Seabrook, via his family trust, owns a substantial proportion of the SabCap voting company. And as such, I do like to invest in companies where the entrepreneur running the business has a vested interest in the underlying performance of a company. So in my perspective, the likes of a SabCap and a CA sales in the current market volatility would certainly be ones that I would consider on any market pullback. So I'm going to leave it there, and I'm going to get my magnifying glass out and have a look at the Q&A. Give me a second. Let me have a look here. Question one from Robert. Thank you, Robert. He says, Nampak, what confidence or expectation do you have that the Zimbabwean sale will close and the proceeds be received outside Zimbabwe as announced? I'm not really aware of a Zimbabwean sale. I'm aware of a Nigerian sale. I'm well aware they're looking to exit Zimbabwe. They have a substantial amount of dollars locked up in that country, and they have managed to get remittance. But as we all know, getting money out of Zimbabwe can be problematic. But as PPC said to me last week, they have a Zimbabwean operating facility there in the cement field, and they managed to bring out millions and millions of US dollars without any restrictions. But saying that, most of their products are sold in dollars, which means it's probably easier to get approval from the Zimbabwean Reserve Bank. So all I will say is, as I said at the start of my preamble discussing Phil Rue's departure, Nampak is restructuring itself. It is slimming down the misadventures of previous management in expanding aggressively into parts of Africa which have not been elegant in its performance. You've seen that they've sold operations in Nigeria. You've seen they've taken one of the lines out of Angola and they're reallocating it to South Africa, where there's demand for their product and the ease of payment will be significantly more elegant to attain. In Zimbabwe, it is my belief that eventually they will exit that market, and there's always an ability to get money out of a country, depending on the level of, let me pick my words carefully, on a percentage of discount that you are prepared to give somebody to take over the asset. Now, all I would say is many in the institutional market believe that the money that Nampak has trapped in Zimbabwe will probably never see the light of day, and as such, it's discounted. So if they do manage to get, tens of millions of dollars out of that country, the market will not believe. So the market has not believed it's possible, and if they do get it out, it'll be a win. So I have no privy knowledge that a sale is imminent or the cash is coming out. But all I can say is in my engagements with management that they are reasonably confident that the restructuring and the simplification of a portfolio will continue, and non-core assets like Zimbabwe will certainly be sold. And we have not had any evidence to date that they have not been true to their word in getting money out of difficult countries. Anonymous attendee, any comments, views on Metrofile and the cautionary it is under? A short history lesson. Many of you may recall there was a flurry in about 2019 before the COVID pandemic of interest in Metrofile. And Housatonic, the US private equity company, offered R3.30 in cash for the company. And everyone got terribly, terribly excited. And then COVID came along and it dragged on. And in the end, the deal floundered because the principals simply could not undertake the due diligence because of the issues with traveling, etc., and the deal fell away. Since then, Metrofile has been a serial underperformer. We've had very lackluster results from the company, and that has disappointed the marketplace. The share price has collapsed from a high of R3 down to a low recently of around R30. It then bounced about R40, R50, mainly on insider buying. Christopher Seabrook, who was a large shareholder in Sabcap, in Metrofile via Sabcap, with a 13% stake, basically exited his stake in a put and call structure to a black empowerment company called Afropulse at 301. So clearly, his timing of that stake sale was very elegant because 9 months later the stock basically was at around 30. The cautionary, I think, is not new news. I think there's been rumours swirling around Metrofile for a number of years regarding the assets, and we've seen a recent management change where the former CEO was replaced by a new gentleman who I've met in Cape Town. I also met the chairlady of the Black Empowerment Company, who is trying to restructure the business. They bought that stake at 301 cents, so they were heavily out of the money. And I think I've said on many platforms, including some notes that I have written, that some companies do better out of a public eye, away from the stress and the travails of analysts like me and other institutions shouting and screaming at management regarding poor performance. You know, we have timelines that we expect to be delivered regarding earnings and growth stratagem. And perhaps companies cannot move that fast. And being out of a public eye, I think, will be a more likely scenario. Now, we saw when the cautionary on Metrofile was released, I think from memory last Wednesday or Thursday, the share price did jump on the day, I think 22 or 23%. It got to about 2 Rand. I have not seen the recent price, so I'm talking blind. But if one were to think logically here, and it's only my personal belief, I have no engagement with the principles that may or may not be involved. I'm just giving a view of an analyst that has covered Metrofile for 25 years, and I followed the trails and pitfalls of that company, knowing what I think could eventually be the permutation play, which would be an unlisted vehicle. If we were to play the games of logic, the stake was sold at 3 and 3 Rand and 1 cents. The Black Empowerment Company are heavily underwater. They own a substantial stake, as does the MIC, the Mine Workers Investment Committee. Between the two parties, they own probably near 50% if you include management. Why would you want to sell a company to an interested party at a substantial discount to recent transactions which occurred around the 3 Rand level? One would assume that anyone doing a deal would want to get back at least what they paid for the stock, or maybe a little bit better. That would be my scenario regarding Metrofile. Will it occur? Who knows? Paying a fat premium to the ruling market price to buy a company is an unusual scenario, given that the stock was trading precautionary at 1 Rand 30. So why would someone pay 3 Rand for it? Who knows? But as I said, the stock was traded to the empowerment firm at 301. And I'd have to believe that at 2 Rand, despite the fact that Metrofile, excuse me, has had indifferent earnings for a number of years. If they do sort out for problem children in East Africa, particularly in Kenya, and what contracts they have left in the Middle East, and focus on what they do best, which is storing boxes in this country, and then eventually migrating that into the cloud, and going back to how Metrofile used to trade, which was a cast iron, fairly low growth, but fat dividend paying company. If I were to tell you that when I first picked up coverage of Metrofile back in the late 90s, its price earnings ratio was 18 times. And the company was a cast iron dividend payer. It was like money in the bank. And as the evolution of this company changed, and the demand for paper in this economy also changed towards less paper and more digital encryption and storage services, Metrofile didn't evolve quick enough, and its natural defensive scenario completely crumbled. They're trying to get back to that. Will it be successful? I don't know, but I think it will be more of a successful business if it's delisted. And I personally do not believe it'll be at 2 Rand. I think it'll be slightly higher, but I say that with no hindsight, with no knowledge. So I'll say that Metrofile is caveat emptor. Buyer beware. Looking down at any other comments, Metrofile, we've done that. Mustang. I've got a dog sitting beneath me here. We've got uh, the takeover regulation panel currently weighing in on the Mustang and Novus transaction. For those of us that may have memories, Mustang has been a favorite of mine for the best part of 2 years. It's been a special situation, delisting buyout story for quite some time. I had a recommendation of a stock at 8 Rand 99 on the 15th of April 2024. And then during the course of June, July, there was stake building by Standard Bank and eventually Perisec, which was quite an interesting period because we were all scratching our heads who would be buying Mustang. And it eventually transpired on the 15th of November that Novus Holdings was the ultimate buyer. And as they'd accumulated 35% stake, they were required under the TRP rules to make a mandatory offer, which they did at a price of 13 Rand in cash, or one new Nova shares, which was then trading at 7 Rand 85, and 700 cents in cash, or two new Nova shares. Now, for those market participants that actually have an inkling of common sense, they know that the cash proportion of this transaction is cast in stone, but the scrip issue changes with market pricing. So it was 7.85 when they did the deal. I think Novus is now trading below 7 Rand. So the varying value of that offer changes. I do not believe that TRP understands simple mathematics. I seem to believe that they think that, well, if it was 7.85 back in November, why isn't it 7.85 now? 7.85 plus 7 Rand gives you this price. Two shares at 7.85 gives you that price. Why are you offering 13 Rand cash? To which any person with a degree of market sanity, who has actually been around the JSE for more than 10 seconds, would understand that prices of companies actually fluctuate with market volatility. So you can't suddenly say the price of a share as a new script is cast in stone at a set point in time. So I think part of the discussions of the TRP and the hoo-ha currently going on is, I believe, the fact that the TRP do not know what they're doing. That's my personal view. I did write a note on Mustang, I think on Monday, to my institutional clients, and I regaled this as my personal perception, that I think that the deal will go ahead. I do not believe there'll be any change in the underlying valuation of the cash offer or the scrip offer of one share in Novus plus 7 Rand, or two shares at the current price and the cash offer 13 Rand. Novus have indicated in a sense they will appeal this, and I'm sure they'll be going to court. The normal appeal process, I think, is 20 or 22 days. But because we've got Easter coming up on the 17th of January, 17th of April, that may delay the process. But what all this does is it just lengthens the timeline to get resolution. The market hates uncertainty. And what the TRP have done, even though they initially approved the deal in November and the Comcom had approved the deal, they suddenly changed their mind. So they've changed their mind without any real what's the word I'm looking for? Without any real justification for changing their mind. And I'm sure that that matter will be something that the judges will consider and give a ruling in due course. So from my perspective, I still believe the transaction will go ahead, but we will have to wait and see. Let me scroll down. I don't cover property, so I'm not going to talk about storage. There's small caps here on resources, which I don't cover. There's another question on Mustex, which I've done. Thank you, Graham, for the comment that you've made 100% return on your investment in a year. It's been a good stock. Hang on. I don't cover Wilson Bailey, so I can't comment on that. Interesting question from Sean Taylor. Hi, Anthony. If you only had to recommend two stocks to buy at current prices for the long term and lock them away for 10 years, what would they be? Well, I will tell you, it would probably either be CA Sales, Stadio, or Sabcap. So if I was you, do not put two eggs in one basket, put three eggs in one basket. And I would think a combination of those three stocks, even at current levels, if you bought them, put them in your bottom sock drawer and forgot about them, I think you will do extremely well. I own all three stocks myself. I'm heavily overweight SabCap and CA cells in my personal portfolio, and all of this is public knowledge. And I have no hesitation in recommending those three stocks on a buy and hold view, as you say, there for 10 years. So if you do them, just bear in mind that there's always market volatility and things go up and down. And I'll always say, do your own research and never rely on an individual on a webinar giving you financial advice. But I have high confidence of the management teams of Chris Forster at Stadio, Duncan Lewis at CA Sales, and Christopher Seabrook at SabCap will deliver superior returns for investors alongside capital growth and dividend growth over the next 10 years. I bought some more SabCap after my SabCap note went out a little while ago. I'm going back now quite a while, and I'm a very happy holder. I've got I've got a few minutes left. Let me see what else is scrolling down here. There's another one on Nampak, done that. Any comment on Zeta? Don't waste your time. It's a dog. It's been a dog since September 2022. Unless you want to hang on for the rest of ZARD to be sold, to accept the last of your capital, I do not like tying up money in dead companies. And to me, Zeta was basically a dead company in September 2022, and it's not one I currently favor. Let me scroll back for one more. There's a couple of questions here on the food sector, Premier and Libstar, Sea Harvest, Oceana. I can't go through them all. I'll say a quick thing on fishing. The fishing sector has improved, but there's no great shakes. I would not be rushing out in the near term buying fishing companies. Oceana looks cheap, but it's cheap for a reason. Sea Harvest looks very cheap, but it's cheap for an even bigger reason. So as it stands right now, I have not recommended Oceana or Sea Harvest, and their time will come, but not quite yet. Premier was one of my top stocks of last year. I selected the count at 52 Rand. It got to 135 Rand. It was my best performing counter last year in my top stocks, up 122%. I am unconcerned if Brait sells. I had a meeting with a client today, and in fact all week, and I've discussed Brait and Premier, and I actually want Brait to sell, because whenever Brait sells, at whatever price the market takes the stock, Premier is an extremely well-run company. It does what it does very, very well. And it has very tight liquidity for what is now a blue chip mid-cap. So there's an old English saying, if the ducks are quacking, throw them some bread. And whenever Brait has sold stock in Premier, it has been lapped up on the market once more. So if they were to sell the remaining, I think near 18% stake, even in a placement or block sale, I'm unperturbed. I think if Brait were to suddenly fall off the tree and not be a shareholder in Premier, it would be to the positive benefit of Premier, and I think the share price would react accordingly. If I could buy Premier at a discount to market right now in any unbundling from Brait, I would certainly take it. It is currently my number one stock in the food sector, the J357, and it has been since the start of January 2024, and I have no need to change. A quick comment on Libstar. Again, it was in my top stocks last year at 3 Rand 30 with a 4 Rand 50 price target. It got to 5 Rand. So it more than met my expectations, and it ended the year up 40%. So I was very happy. But then they came out with a very lackluster trading update in the festive period. And then results which came out a couple of weeks ago were, again, nothing to write home about. And for those that can read cryptic messages, because Libstar have a wonderful knack of using fancy language in their results statements and in their outlook statements. You know, why use one word when you can use 1,000? And what they basically did was put a sign on their door saying, "We're for sale, make us an offer." So as I've been saying for the best part of a year and a half, Libstar is a special situation. I think it is probably worth £7.50 a share. Will someone pay that? Who the hell knows? But the private equity partner owns 38%. There are some very, very interesting component parts inside Libstar, which I'm sure would attract significant interest, like Lancewood, the dairy company, Rialto Foods, the major grocery and value-added supplier of products to Woolworths and Checkers, some of the bakery operations in Amaro Foods, Millennium Foods. There's also some dogs like Finlar Foods, which is currently not doing very well, although they do have a very large chicken schnitzel contract into Woolworths. But they recently lost half of their McDonald's patty business, which caused that business to go backwards. But Libstar to me is a breakup. But you'd have to have nerves of steel to buy that stock. But certain institutions do have nerves of steel. Interestingly, John Bickard, the doyen of value investing in this country, has been a material buyer of Libstar in the last few months of the last year, clearly believing, as I do, at some point someone will make a tilt at Libstar and either take it over as a whole or maybe break it up. But given they put the for sale sign on the door literally a couple of weeks ago, it's now a free-for-all. So we'll await to see what happens. I've gone over my time, and as such, I'm sure many of you have better places to be than to listen to me ramble on about what is going on in the universe. But I'd like to thank Pascal and Gary Boyson at Rand Swiss and the entire team there for once again having me on this session. The entire webinar is always again recorded and will be on a YouTube link in the coming days. So for those that have maybe missed the ramblings and the fast pace narrative of the stocks that I've given, listen to the website or listen to the YouTube or call my friends at Rand Swiss to try and get some more advice. But from me, I wish you all in the dark a wonderful Thursday evening. It is scorchingly hot here in Cape Town. It was like winter a couple of days ago, and somebody flipped the switch and put on the fan heater, and it's now scorching. So from me, Anthony Clark of Small Talk Daily, if you haven't followed me on social media, please do so at Small Talk Daily Research. You'll pick up lots of tidbits, and the dog who's sleeping underneath my desk. I will see you in another quarter. Take care and chat soon.